this growth stock has 19% upside according to Wall Street. Now, the range of estimates suggests that the stock could be worth between $119 and $135 while it's trading at $105 today. So, analysts are certainly bullish about this growth stock right now. What is this growth stock? It is Alphabet, Google. And I'm not surprised. This company has done an excellent job over the last 2 decades in growing its business and securing its dominance. And in recent quarters, it faced some headwinds, which has caused its stock price to come down, giving investors an opportunity to buy this stock at a better valuation. So let's go through why I think investors, Wall Street analysts, think that you should be buying Alphabet stock hand over fist right now. Starting with its revenue growth. If we look over the last decade, Alphabet has consistently grown its revenue between 12 and 24%. You look at this band here between 12 and 24%. If we look before the outbreak, it was consistently in that range. And then you had COVID-19 and you had the initial drawdown in advertising spending. Then you had the explosion and now it's back down. So volatile times after the outbreak. I suspect Alphabet will settle back down in its long-term range of revenue growth between 12 and 24% over the next decade after these near-term headwinds subside. So in addition to growing revenue above double digits over the last decade, Alphabet's business is incredibly lucrative. The operating profit margin has consistently been above 20% in the last decade, coming down a bit and then rising up and coming down again, although still staying above 20%. Additionally, investors have pushed Alphabet to finally make some cost cuts, and Alphabet finally responded by actually cutting some costs and laying off some people, which I was glad to see. The company had, I believe, gone a little bit ahead of itself in terms of its spending, its hiring, the perks it offered its employees, and its projects, its moonshot projects. I think it was getting a little bit ahead of itself. I'm glad it's pulled some of that back. And so going forward, it's going to be a more efficient company because it took the necessary steps to bring costs down. I hope it takes one step further and brings costs down a little bit more. I I I'm not a big fan of the perks that Alphabet offers employees and the lucrative wages it pays employees to attract them. I think the company is established enough and to be able to recruit talent without needing to offer wages that are so high and packages that include perks that are so high. So I'm looking forward to seeing improved profitability from Alphabet as it rebounds its revenue growth going forward. And I think Wall Street analysts might also be looking forward to that as well. I'm sure they've noticed that Alphabet has implemented several rounds of cost cuts. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. And finally, the stock is not expensive according to its forward price to earnings ratio. Looking at this metric, Alphabet stock is trading at a forward PE of 17.42, which is near the cheapest it has been going back about a year and a half. So you've got a company that's taken the necessary steps to improve profitability, a company that's already been very profitable over the last decade, company that is facing near-term headwinds that are likely to be short-term, and demonstrated that it can grow revenue in the double digits and grow profit margins over time and keep profit margins healthy. I can see why Wall Street analysts are bullish on Alphabet stock. And if you've been watching my channel, you know I've been bullish on Alphabet stock for the last 6 months or so. So I agree with Wall Street here in saying that, investors have good upside here with Alphabet. All right, that's all I've got for this video. Thank you so much for watching. I really appreciate it, and I really hope I'll see you again sometime soon.